I'm Shaun Osborne, Managing Director and Chief Currency Strategist at Scotiabank. We're heading into the home stretch of 2018, and we think it's worth taking a quick look back on how the FX market has developed so far and discuss our expectations on three key currencies for the year ahead. We've maintained a bearish view on the outlook for the US dollar overall this year, following its significant decline in 2017. Unfortunately, that view has not been reflected in market developments. The dollar's held up much better than we expected amid firm US growth, rising interest rates, and a generally robust equity market. But we still think there are some challenges ahead for the US dollar, which makes it hard for us to embrace a bullish outlook. Firstly, we think a lot of good news in terms of growth and interest rate trends are already priced into the exchange rate at current levels. Secondly, investors have already accumulated a significant long US dollar position. This suggests to us that while the US dollar may not fall too far in the short run, it will struggle to improve significantly. And finally, in the longer run, we still firmly believe that widening US fiscal and current account deficits point to a weaker US dollar. That's been a pattern of trade over the last 40 years, and there's no reason to believe that relationship has broken down. Moreover, the longer run secular trend in the US dollar reversed bearishly, right about where we expected it to develop in 2017, given the dollar's tendency to swing alternately higher and lower over trend cycles that last around 8 years on average. The Canadian dollar has struggled to improve in line with our expectation of modest strength through the second half of the year, and currently reflects a loss of a little under 5% for 2018 so far versus its US counterpart. Trade tensions and weak Canadian crude oil prices have weighed on the currency's performance, but we continue to feel that momentum in the domestic economy and additional Bank of Canada monetary policy tightening can boost the Canadian dollar to the 125 area over the course of the coming 12 months. Our base case view on the pound sterling has been that the UK government will reach a deal with its European counterparts and negotiate a smooth exit from the European Union. But that view is looking at some risk, given Prime Minister May's difficulty in getting a deal over the line in Parliament, and with time now running very short to nail down an agreement. The risk of a chaotic UK departure from the EU is rising uncomfortably, and this event alone is liable to inject a high degree of volatility in the FX markets in the next few weeks. An 11th hour deal on Brexit will trigger a relief rally in the pound and may help lift other currencies against the US dollar somewhat. Alternatively, a cliff-edge Brexit, that's to say one which leaves the UK with no structure around its future relationship with the EU, will prompt a knee-jerk drop in the pound that may prove to be quite significant. You can find more thought-leading content from Scotiabank on our website, and you can also follow us on Twitter at ScotiabankGBM and at ScotiabankFX, as well as on LinkedIn. I'm Shaun Osborne, thanks for watching.